Welcome to The Explainer. Today, we're unpacking a fascinating, honestly almost contradictory moment in the financial world. We're looking at a dramatic financial divergence that played out in the June quarter. On one side, we have Indian corporations, often referred to as India Inc., just surging forward, particularly in dynamic sectors like the pharma industry, and making these massive global moves. But then on the flip side, we have private equity, or PE, hitting a really massive slump. It's literally a tale of two markets. And understanding this split gives us an incredible window into how totally different financial heavyweights view the exact same economic landscape.
Okay, let's dive into this. Why on earth are corporations buying while equity firms retreat? That is the central mystery we're solving today. Think about it. When you have two major players looking at the exact same data, the exact same quarter, and the exact same market conditions, why is one group aggressively buying while the other is rapidly retreating? What exactly does India Inc. see that private equity doesn't? Or conversely, what risks are private equity firms anticipating that corporations are just choosing to power right through?
Section 1. The June quarter divergence.
Just so we're all on the same page, when we talk about this corporate surge, we are really talking about M&A, mergers and acquisitions. Basically, instead of taking years and years to build a new factory or, say, develop a drug totally from scratch, these companies are simply buying assets that already exist. It's an aggressive, purely offensive play for immediate growth so they can capture new territory right now.
Now, what's really interesting here is the striking contrast in mindsets. India Inc. is completely on the offense. They are laser-focused on global expansion and hitting peak activity. They want a bigger piece of the map, and they are buying their way in. Meanwhile, private equity, which is an industry built almost entirely on buying, improving, and selling companies, is in a highly cautious, totally defensive posture. It's just a stunning juxtaposition.
Section 2. India Inc. goes global.
And this brilliantly illustrates exactly what we're talking about. India Inc.'s M&A activity didn't just grow, it hit absolute peak levels. But right next to that, private equity buyouts are sinking fast. This isn't just a minor statistical anomaly, guys. It is a massive structural divergence in how capital is being deployed.
So, the crucial point is what that peak actually represents. This is an aggressive global push across key sectors. We're not just talking about Indian companies buying other Indian companies to consolidate local power. No way. This is a highly confident, incredibly strategic push into international markets. Taking the pharma industry as our prime example, this means Indian corporations are out there acquiring assets, research pipelines, and manufacturing capabilities globally. They are taking their domestic strength and using it to establish a dominant, undeniable footprint on the world stage.
Section 3. PE buyouts sink 40%.
Mine is 40%. Let that sink in for a second. In the world of high finance, a 40% drop is pretty much the definition of hitting a brick wall. This means the deep well of private capital that usually fuels so much of the world's corporate turnover has dried up significantly. It's leaving billions and billions of dollars just sitting on the sidelines doing nothing.
So, why the sudden stop? Well, private equity is slamming on the brakes and adopting a highly cautious global market outlook. And look, to be completely fair, neither strategy is inherently right or wrong here. They are simply different reactions to the exact same environment. See, private equity firms rely heavily on borrowed money, which makes their business models incredibly sensitive to global interest rates and short-term economic turbulence. If the math doesn't offer a clear, safe return, they'll just wait it out.
Section 4. What this shift means.
Synthesizing all these takeaways gives us a crystal clear picture of two distinct financial engines moving in completely opposite directions. India Inc. is playing a long-term offensive game. They're utilizing a global push and snapping up market share while their competitors hesitate. Conversely, private equity is heavily defensive right now. They're prioritizing capital preservation and waiting for the dust to settle. Basically, it tells us that right now, the global market is rewarding long-term corporate builders who have cash and a clear vision over short-term financial buyers who kind of need perfect economic weather to make their moves.
Which brings us to our final and honestly most compelling question. Is India Inc.'s global bet just beginning? I mean, if they are acting with this much confidence while private equity runs for cover, imagine what they might achieve as they continue to integrate these new global assets. The June quarter revealed a remarkable changing of the guard in how capital is deployed. Thank you so much for joining me for this explainer. Keep questioning the data, and definitely keep your eyes on the global picture.